Every large company reaches a point where growth becomes both an opportunity and a challenge. In the early days of a business, financial management can be handled using simple accounting software, spreadsheets, and manual processes. Owners and managers often know exactly where money is coming from and where it is going. As the company grows, however, financial operations become more complex. More customers, more employees, more suppliers, and more transactions create a need for systems that can manage information accurately and efficiently. A large company that generates billions of Kenya shillings in annual revenue cannot rely on the same financial tools used by a small business. The risk of errors increases, reporting becomes slower, compliance requirements become stricter, and decision-making becomes more difficult. This is why successful enterprises invest heavily in financial systems. These systems help leaders understand performance, manage risks, control costs, improve profitability, and support future growth. Financial systems are no longer viewed as simple bookkeeping tools. They have become strategic assets that help companies compete in increasingly demanding markets. Modern financial systems provide real-time information, automate repetitive tasks, reduce human error, and enable leaders to make informed decisions quickly. Companies that fail to modernize their financial operations often struggle with inefficiency, cash flow problems, and poor visibility into business performance. One of the most important financial systems for any large company is an enterprise resource planning system. Often referred to simply as an ERP system, it acts as the central hub for business operations. Instead of having separate systems for accounting, procurement, inventory management, payroll, and sales, an ERP system brings everything together in one place. This creates a single source of truth across the organization. Imagine a manufacturing company with operations in multiple regions. When a sale is made, the inventory levels are updated automatically. Financial records are adjusted immediately. Procurement teams can see stock levels in real time. Management can review financial reports without waiting for data from multiple departments. This level of integration reduces duplication, eliminates inconsistencies, and improves efficiency throughout the organization. The benefits of an ERP system extend far beyond convenience. It improves data accuracy, supports faster reporting, strengthens internal controls, and helps businesses scale more effectively. When a company expands into new markets or launches new products, the ERP system provides the foundation needed to support that growth. Another critical financial system is the Treasury Management System. Cash is often described as the lifeblood of a business, and large companies must manage significant amounts of money every day. A company may have dozens of bank accounts, international payments, loan obligations, and investment activities. Without proper oversight, managing cash can become extremely difficult. A treasury management system helps companies monitor cash positions in real time. It provides visibility into available funds, expected inflows, and upcoming obligations. This allows financial leaders to make informed decisions about investments, borrowing, and liquidity management. Companies can avoid cash shortages while ensuring excess funds are used effectively. For example, a company may discover that it has several hundred million Kenya shillings sitting idle in multiple accounts. With a treasury management system, management can identify these funds and allocate them to investments, expansion projects, or debt reduction initiatives. The result is improved financial efficiency and stronger profitability. Financial planning and analysis systems are also essential for large organizations. While accounting systems focus on recording historical transactions, planning systems focus on the future. Business leaders constantly need answers to important questions. What will revenue look like next year? How will inflation affect costs? Can the company afford to expand into a new market? What happens if sales decline unexpectedly? Financial planning and analysis systems help answer these questions through budgeting, forecasting, scenario planning, and performance monitoring. Instead of relying on guesswork, executives can model different situations and evaluate potential outcomes before making major decisions. Consider a retail chain planning to open new branches across the country. Management can use forecasting tools to estimate future sales, staffing costs, rental expenses, and expected profits. By analyzing multiple scenarios, leaders can identify the most financially sustainable strategy. This reduces uncertainty and improves decision-making. Financial reporting systems are equally important. Investors, lenders, regulators, and shareholders expect accurate financial information. Large companies often operate across multiple business units, subsidiaries, or countries. Consolidating financial information manually can be time-consuming and prone to errors. Advanced financial reporting systems automate the collection and presentation of financial data. They generate income statements, balance sheets, cash flow statements, and management reports quickly and accurately. This allows leaders to focus on analysis rather than data gathering. Timely reporting provides several advantages. Management can identify problems earlier, monitor performance more effectively, and respond to changing market conditions faster. Accurate reporting also builds trust with investors and financial institutions, making it easier to access capital when needed. Risk management systems have become increasingly important in today's business environment. Every organization faces risks. These may include financial risks, operational risks, cyber threats, regulatory changes, fraud, and market disruptions. Large companies must identify and manage these risks proactively. Risk management systems help organizations monitor threats, assess their impact, and implement appropriate controls. Instead of reacting after problems occur, companies can anticipate challenges and reduce their exposure. This protects financial performance and strengthens long-term stability. For example, a company heavily dependent on imported materials may face risks related to currency fluctuations. A risk management system can identify this exposure and help management develop strategies to reduce its impact. This may include hedging arrangements, supplier diversification, or pricing adjustments. Compliance management is closely connected to risk management. Governments and regulatory bodies continue to introduce new reporting requirements and standards. Large organizations must comply with tax laws, financial reporting standards, labor regulations, data protection rules, and industry-specific requirements. Compliance systems help businesses track obligations, monitor deadlines, and maintain proper documentation. This reduces the risk of penalties, legal disputes, and reputational damage. In industries such as banking, insurance, telecommunications, and healthcare, strong compliance systems are especially important. Business intelligence and financial analytics platforms have become essential tools for modern enterprises. Companies generate enormous amounts of data every day. The challenge is transforming this data into useful insights. Analytics platforms collect information from various systems and present it through dashboards, reports, and visualizations. Executives can monitor key performance indicators in real time and identify trends before they become major issues. For example, a chief executive officer can review profitability by region, product line, or customer segment within minutes. A finance director can analyze spending patterns and identify opportunities to reduce costs. Sales leaders can monitor revenue trends and adjust strategies accordingly. Artificial intelligence is making analytics even more powerful. Advanced systems can identify patterns, forecast future outcomes, and provide recommendations based on historical data. These capabilities help companies make smarter decisions and gain a competitive advantage. Accounts payable automation systems are another valuable component of a modern financial infrastructure. Large companies process thousands of supplier invoices every month. Manual invoice handling is slow, expensive, and vulnerable to errors. Automation systems digitize invoices, match them against purchase orders, route them for approval, and schedule payments automatically. This significantly reduces processing time and administrative costs. The benefits extend beyond efficiency. Automated systems improve accuracy, strengthen internal controls, and reduce the risk of fraudulent payments. Suppliers also benefit because payments are processed more consistently and predictably. Payroll and workforce financial management systems play a major role in large organizations. Employee compensation is often one of the largest operating expenses. Managing salaries, benefits, taxes, pensions, and workforce planning manually can be overwhelming. Modern payroll systems automate calculations, ensure compliance with regulations, and provide detailed workforce insights. Management can analyze labor costs, monitor productivity trends, and plan staffing requirements more effectively. For companies operating in Kenya, payroll systems can simplify the management of statutory deductions, pension contributions, and tax obligations. This reduces administrative burdens and helps maintain compliance with relevant regulations. As businesses expand internationally, multi-currency financial management becomes increasingly important. Companies operating in multiple countries face challenges related to exchange rates, foreign taxes, cross-border payments, and financial consolidation. Multi-currency systems allow organizations to manage transactions in different currencies while maintaining accurate financial records. These systems automatically convert values, track exchange rate impacts, and support international reporting requirements. Without proper systems, currency fluctuations can create confusion and distort financial results. Large companies need clear visibility into international operations to make informed strategic decisions. Fraud detection systems have become essential due to the increasing sophistication of financial crime. Fraud can occur through unauthorized payments, cyber attacks, false invoices, employee misconduct, or identity theft. Even a single incident can result in substantial financial losses. Modern fraud detection systems use advanced algorithms to identify suspicious activities. Transactions that appear unusual can be flagged automatically for review. Access controls, user monitoring, and real-time alerts help protect financial assets and sensitive information. Cybersecurity is now closely connected to financial management. Financial systems contain valuable information that criminals often target. Companies must invest in strong security measures to protect customer data, financial records, and intellectual property. One of the most significant developments in recent years has been the growing use of automation throughout financial operations. Tasks that once required hours of manual effort can now be completed automatically. This includes invoice processing, expense management, reconciliations, reporting, and forecasting. Automation provides multiple benefits. It reduces human error, lowers operating costs, improves speed, and allows finance professionals to focus on higher-value activities. Instead of spending time entering data, employees can concentrate on analysis, strategy, and business improvement. Cloud-based financial systems are also transforming how large companies operate. Traditionally, organizations invested heavily in servers, hardware, and information technology infrastructure. Cloud solutions allow companies to access sophisticated financial tools through the internet. This approach offers greater flexibility, scalability, and cost efficiency. Updates can be deployed quickly, remote access becomes easier, and organizations can scale resources based on their needs. Cloud platforms also support collaboration across different locations and business units. Another important trend is real-time financial reporting. In the past, companies often waited weeks or months to receive complete financial information. Today, modern systems provide continuous access to up-to-date performance data. Real-time visibility enables faster decision-making. Leaders can respond quickly to market changes, identify emerging opportunities, and address problems before they escalate. This agility is particularly valuable in competitive industries where conditions can change rapidly. Large organizations should also consider environmental, social, and governance reporting capabilities within their financial systems. Investors and stakeholders increasingly expect transparency regarding sustainability initiatives and corporate responsibility efforts. Financial systems are evolving to support the collection and reporting of these metrics alongside traditional financial information. The most successful enterprises do not view financial systems as isolated tools. Instead, they create an integrated ecosystem where information flows seamlessly between platforms. The accounting system feeds information into reporting platforms. Treasury systems receive data from banking partners. Analytics platforms gather information from across the organization. Risk management systems monitor activities and identify potential threats. This integration creates a powerful foundation for growth. Leaders gain a complete view of the business, enabling better planning, stronger control, and improved performance. Employees spend less time dealing with administrative tasks and more time creating value. A company generating 5 billion Kenya shillings annually may initially believe that basic accounting software is sufficient. However, as operations expand, limitations quickly become apparent. Reporting becomes slower, compliance requirements increase, forecasting becomes more difficult, risks become harder to manage. Modern financial systems address these challenges by providing the structure and visibility needed for sustainable growth. Ultimately, financial systems are investments in the future of the organization. They help companies manage complexity, improve efficiency, strengthen governance, and support strategic decision-making. While implementing these systems requires time and resources, the long-term benefits often far outweigh the costs. The companies that thrive in the coming years will be those that embrace modern financial technology and build strong financial foundations. By investing in integrated systems for accounting, treasury management, planning, analytics, compliance, payroll, security, and reporting, organizations position themselves for greater profitability, resilience, and long-term success. In an increasingly competitive business environment, having the right financial systems is no longer optional. It is a necessity for sustainable growth and continued market leadership.